Thank you so much for joining us this afternoon. I really appreciate you being here with us today. I'm going to share my screen with you. If you have any questions throughout the presentation, please feel free to send a note in the chat box and I'll try and get to all of your questions. As well, if you have anything that's more confidential, more specific that you'd like to ask me after the fact, please feel free to reach out. Today, we're going to be talking about the fundamentals of financial planning and investment strategies. I'm Jennifer Watson, Managing Partner of Watson Investments and Portfolio Manager with through Aligned Capital Partners. My email is jennifer@watsoninvestments.com. Please feel free to also give us a call and follow us on Facebook, Instagram, YouTube, and LinkedIn. So we're a holistic wealth management firm. Our office is located in downtown Oakville, and we help clients across Canada. We take a holistic team approach to helping our clients and have been operating and helping clients for over 30 years.
Jennifer, I'm not sure that the screen share is working right now. I cannot see your presentation.
Oh, okay. Thank you for letting me know. So that is Adam talking for anybody who just heard his voice. There we go. Can you see it now?
Perfect.
Okay, thank you. Okay, so there's the contact details back up on the screen. There we go. So that's that was what I was referring to with Watson Investments. Okay, we're going to put a poll up on the screen right now. I'd like to hear from you. Today, we're going to be covering how to retire comfortably and stay protected from inflation, investment tips for best results, and estate planning, how to give more money to your heirs. And I'd like to hear from the audience, what's the most important thing that we're going to cover today? So we'll leave this up on the screen just for a moment. In about 30 seconds, we'll close the poll. Okay, let's close the poll and see the results. Okay, so the most important thing to our audience was retire comfortably. The second was the investment tips, and the third is estate planning. So that's great feedback. Thank you for that. So that's the order we're going to go in today then. We'll talk about retirement first, then the investment tips, and they really tie in together. So that works really well. And then we'll talk about very briefly estate planning. And again, any questions you have throughout, feel free to add them in the chat box. So before we get into that, we need to know a few basics. So I'm just going to recap some basics you might already know and around priority setting. So when you have a certain amount of money every month that you can put aside for your future, we want to make sure that is going to get your biggest bang for your buck. So where should that money go? So there's tons of different types of accounts that we need to even consider before we even start thinking about investing. The type of accounts are, we have TFSAs, RRSP savings accounts, non-registered investment accounts. For anyone who's works for themselves and is incorporated, you might have a corporation or a holding company, and RRSPs for children's education and RSPs or RIF accounts. You might also have some locked-in accounts in there. So when we're looking at our priorities, make sure that you're putting the money into the vehicle that's going to help you achieve your goals. So is that money you want in the short term? Is it money for retirement? What's the purpose of the money? The second thing we want to look at is taxes and government benefits. So for taxes, you want to say, if you're in a higher income bracket, maybe the RSP makes more sense for you. If you're coordinating things with your spouse and you want more money in their name, but you want the benefit, then maybe it's a spousal RSP. Once we've decided the RSP is at a high enough level that we don't want to keep adding to that, maybe then we're using the tax-free savings account for for future savings, which can be invested in equities if that makes sense for you, and really plan for that future. When I mentioned government grants, so RRSP, if you're saving for your children or grandchildren's education, make sure you're maximizing the amount that you can get from the RRSP from the government. There's a total of $7,200 per child that's eligible over the course of several years. So make sure you're maximizing that so that you get those benefits. Non-registered accounts, those ones are fully taxable. So we want to make sure that what investments we hold there, we're very mindful of the taxation. And RSPs, they will get converted to a RIF account, which makes then when that happens, every year there'll be a calculation that has a mandatory amount of money that has to come out of that type of account. This can sometimes be done prematurely. So it's actually the year you turn 71. At the end of that year, you need to convert. And so 72 is when the money starts to come out. Sometimes for retirement planning, we will actually convert some or a portion of the RSP to a RIF account before that deadline. And it can help with tax planning and also recreating that paycheck. So that's a lot of information, but I just wanted to give a quick little overview that there's a lot of different considerations with the different types of accounts. All right, retirement planning. So we have Eric here on the screen. And we're going to talk about the retirement planning in terms of how to understand when you can retire, how you can retire comfortably without the fear of running out of money. And we're also going to be addressing inflation. This one's a particularly hot topic right now because, I mean, it's all over the news. Inflation is higher than it's been in a while. So we're going to address, how you can actually make sure that your portfolio is protected against inflation. Well, anytime we're looking at retirement planning, what we have to do is figure out how much we spend and how that's going to differ in retirement. So it's maybe doing a budget exercise, and that really means different things to different people. For some people, it might just be meaning figuring out how much of money you need to put away for your future. So it might be figuring out that gap for saving towards retirement planning, and making sure that every year or timed with our paychecks, maybe it's bi-weekly, that we're putting away that money for that future. So the budget exercise can be as detailed as you want or as high level. We definitely encourage you to do this at some level and revisit it periodically. So when we're looking at the retirement forecast and, how can we actually retire comfortably, we need to figure out that number. So how much are you spending today? What's not going to be there in the future and what's going to be added in the future. So common things we always hear is maybe there won't be as many children living at home. So maybe your food expenses are going to be decreased. Maybe your gas bills are decreased because you're no longer commuting. But also now maybe you have more time on your hands. So maybe you are now able to travel a lot more. So maybe your travel expenses actually go up in retirement. These type of things we need to think about because then we have a more accurate picture for putting it into a projection that can help us determine if you can comfortably retire while preserving your lifestyle and also the lifestyle you aspire to for retirement. So to give an example of this, we have Eric. So Eric earns $110,000 every single year. He wants to retire at age 60. We're using the life expectancy based on Statistics Canada and the age of 65. He's a male, so we're projecting out to age 95. Always encourage people to project out longer, even project out to 100 if that gives more comfort. Eric is spending $80,000 net annually in retirement. That's his goal. We're assuming a 5% return on investments. So investments, how we're coming up with that return is based on what he's actually invested in. And then we've taken it after fees and made it a little bit more conservative because we'd rather be a little bit more conservative in the projections than have that fear of running out of money. And inflation is set to 2%. We're going to talk a little bit more about inflation in just a few minutes. But inflation, the 2% is about the 100-year average of inflation. So that's what we use in our projections. And then Eric's home is valued at $1 million, appreciating annually at about 3%. Some areas, especially in the last year and a half, it has gone up definitely substantially more, which is a good reason why we actually want to redo the cash flow projections periodically, because circumstances change and it's good to revisit it, and also can provide a really great tool for comforting us and keeping us accountable and on track for our retirement goals. And we want to make sure that what your OAS, so your old age security, is going to be, and your Canada pension plan. So we can actually request at a certain age, you'll be eligible to request to get a statement from the government to figure out, how much have you already paid into and what does this look like. So that helps us, again, make it more accurate of a projection. And then Eric also is paying $400 towards his line of credit per month, and any extra savings is going towards his RRSP. He doesn't have any work plan. He has approximately 700,000 in RSPs and approximately 40,000 in TFSAs. He does have some debts, which will be paid off by the age of 60. So we've assumed the debts, we've put everything into the cash flow projection. Okay, so let's take a look now at what that looks like for Eric. So we've put all the details into the cash flow, and you can do tons of different scenarios, and it's really actually encouraged to do many different scenarios of, retiring a little bit earlier, a little bit later, spending a little bit less, spending a little bit more, downsizing, things like that. So what we ended up seeing with Eric is, you can see my mouse on the screen. Okay, so what we end up seeing is that Eric actually, based on all of these assumptions, what he wants to spend, he has a shortfall. The shortfall starts midway through retirement. So it's a great thing that now we've done this exercise, we figured out in advance that he has this shortfall. So what are his options to combat that? Well, he can spend less, he can retire later, he can save more, could downsize and reinvest the proceeds. So what you can actually end up doing then is, the sooner you know what that future looks like for you, you can make all these different tweaks. And sometimes it's not significant tweaks. Maybe it is adding an extra, a small percentage off of each paycheck that goes and gets invested right away. And because money is being invested more frequently, you have that additional compound interest. And then because you've done the tax planning, you're putting that money that you can invest into the right vehicle, and knowing why you're investing it. So you're able to invest it in money in areas that can have that longer term growth. Then maybe it can make the plan that much better, that much quicker. Things like even retiring a year later can make a huge difference. And I know that doesn't appeal to everybody. So that's why it's, great to look at this as soon as possible to make sure we can make minor adjustments to fix that shortfall and ensure that that doesn't happen. So how do we ensure inflation is not going to impact the portfolio and your future? Well, I mentioned that we put in the 100-year average of inflation. And when we were talking about how much are you going to spend now and how much do you think you might spend in retirement, we were talking about that all in today's dollars. That's the easiest way to plan. It's easier than talking about it in future dollars, which might seem like an astronomical amount of spending, but really it's just gone up with inflation. So we want to take a look at, what has the past looked like? Well, the average inflation from 1915 to 2021 was 3.1%. Target inflation is about 2%. And where are we at right now? Well, I'm just going to switch screens for you for just a second. And we're going to take a look. We're going to take a look at what the inflation has done. So this is Trading Economics public website, so everyone can go to this. 1 year of inflation. This is what's happened in Canada. So you can see the inflation has changed drastically. Part of the reason why it's in the news right now, and because it's at a level higher than the targeted rate. So this is why people are paying more attention. So then the 5-year, you can see how it's hovered over time and how it has gone up. And then the maximum inflation, you can also take a look here at seeing what that maximum inflation really is. Okay. Back to our slides. So how can we combat inflation? Well, what we can do beyond just looking at the budget, beyond the forecasts and figuring out, how we should be we should be positioned, we want to look to equities. So if you figure out how comfortable you are with risk, how long you're investing for, again, what vehicles you're investing in, the biggest thing that's going to help combat inflation for your portfolio is having growth in the portfolio. That seems obvious. It means not holding cash in the account unless it's for short-term emergency spending needs. But cash with inflation means that every single year that money is actually worth less. So you need the money to grow and work for you, and that seems quite obvious. There's this graph on the screen, I think really highlights what we all know, but sometimes in the short-term volatility might forget. So this is showing us the growth of a dollar over time from 1973 to 2020. And if we look at the US large company index, that growth of the dollar from 1973 to 2020 has now grown to $129. And if you had kept it in something fully safe, what would have happened? It would have let's say is the treasury bill. It's now grown to $8. So that's not enough. But where does that balance lie? Because what you can see from that top line, the gray line, that there's a lot of movement. There's a lot of up and down. And then you can see the green and blue, which shows the US credit index and the US government bond index. And those are showing less growth. However, that growth over time was significantly more stable. So when we're figuring out what's that right balance, and the fact that we want to be in equities to some degree to get that long-term growth, we need to make sure that you can figure out that risk versus reward, and that you're going to feel comfortable with that volatility, that you're going to feel comfortable investing the money for the long run. And we're going to talk a lot more about this in the investment section. But from a psychology point of view, there's so many different things to consider. In this past, in the pandemic, luckily we had such a quick recovery. But in the March 2020, that first initial crash and decline, investors didn't know the market was going to recover so quickly. And there is a lot of uncertainty. And, there's that market volatility. And depending on what was happening for you at that time, it might have felt different. So depending on how close you are to retirement, your job security, how many dependents you have, things like that, that can change how we feel when the market is more volatile. So it can make it really hard as investors. But I am going to walk you through a little bit more around, figuring out that right mix and right balance for you, and then talk a little bit more specifically around when I'm saying equities, what we're referring to and what that means, and what we think is really best. There was a really interesting study done by Vanguard, and it looked at how do you quantify the advisor's return. And you're all engineers, so I know you must love numbers and love the analytics. So it's great that Vanguard was able to actually quantify that additional value that an advisor brings. And the biggest value is actually the behavioral coaching side. Beyond the withdrawal strategy, the asset location strategy, figuring out the right investments, figuring out where to hold them in which accounts, making sure costs are lower, making sure you're rebalancing. Beyond all of those, the biggest value add was the coaching side and figuring out really what that means to me is it means figuring out what's that right mix of the equities versus the fixed income for you, and how can we coach you. So one of the things we do for clients is beyond just the cash flow projections being a retirement exercise, it's also an exercise to calm any anxiety we have when we're investing in the market. Because it's looking at that long-term approach. It's showing how you need growth in the portfolio, and therefore there is going to be expected volatility, but it's really realizing what's the right mix of that volatility that makes sense for you and your circumstances. And then it will help us, stomach any ups and downs and really make sure that we're achieving our goals in the smoothest possible way. Okay, I have another poll ready to go up on the screen. I'm going to put that poll up and then I'll read the few messages that have come into the chat box. So really curious to learn from the audience. What would make you want to work with a wealth manager? So, there's tons of answers to this question, but the pick list will ask you about, is it investment and financial planning services? Is it investment services only, the team, the process, the communication style, additional offerings such as, speaking and events or other? Okay, so let's close the poll in 30 seconds. So if you could finalize your answers. Perfect, thank you. Okay, so the most important thing is the investment and financial planning services. And the second was the team. And then as for the chat box, thank you so much for your question, Dan. So the question was around RRSPs, and Adam, thank you very much for answering the specifics around that. Yeah, I did do a very, very quick overview. On our YouTube channel, you can find more resources, including more videos around the basic fundamentals of financial planning and investing, which would go into a lot more details around the different types of accounts. I also have presented to the engineers who trained through EPIC in the past, and that recording is also on YouTube. That one is different than this presentation, and that one I did go into a little bit more about those competing priorities and which vehicles you should be choosing for which priorities are most important for you. So you can take a look at that if you'd like in the future, just to understand more around the different types of accounts. So working with an advisor, make sure that you find somebody that understands you, you feel comfortable with, that's going to give you a suitable financial plan. You have to have a plan. You can't just have investments. Having investments with that written financial plan is going to create a significantly better outcome and a significantly better investment experience. So Eric, our gentleman, is back on the screen here, and he's happy because he understands now the adjustments he needs to make for his retirement planning, and he knows that he can do more cash flow projections over the years until he actually pulls that trigger and decides to retire. Another poll, and then we're going into 5 key investment tips. So the biggest excitement about money is, I'd like to hear from the audience. So if we put the poll on the screen. So is it the freedom of career decisions, what I can buy, security, helping my family, retiring as quickly as possible, being financially free when I want, and buying a second property? So what is the most important thing that you feel for yourself today? And we'll close out the poll in 30 seconds. Okay. Being financially free when I want to retire is the most important thing to the audience. The next one is security. That makes a lot of sense. What we hear from prospective clients and what we've heard actually consistently for now 30 years is the security of being financially free, basically. When we ask clients around, what is the number one fear? It is always, regardless of account size, regardless of spending habits, it's always the fear of running out of money. And that's why the cash flow, again, is such a powerful tool. And in my perspective, the only tool that can safely lead to retirement. Some people, very few these days, but some people have fully indexed pensions. That's a pretty safe way then to know that you'd be comfortable in retirement. But you'd still want to make sure that, those extra dreams and goals that you want to achieve are able to be fulfilled. So it's make sure you have that cash flow done. And some of you might have the capabilities to do that in Excel, and I completely understand. I actually helped an advisor before. She was a very, very competent advisor, but yet for herself, even, she needed that coach, she needed that third party, needed that bouncing back of ideas and confirming what she knew, because she would run her own numbers. And so I ran a separate cash flow. We compared the cash flow projections for her, and we both had come to the exact same conclusion that yes, she could comfortably retire, but it was that extra opinion, that sounding board that really made all the difference. As well, what we see is sometimes when one person is a little bit stronger on the quantitative side or even understanding investments, it's helpful if you're in a relationship and you plan financially together to have a third party that leads that conversation and also shows the same numbers and conclusion that you yourself had gone to and figured out. So someone asked a question, and before I go to the investment tips, I'll answer it. So the question is, when somebody retires, does the government pay pension forever, or can one run out of pension money? So yes, you will get old age security. Sometimes it can be clawed back, the old age security, depending on how much your income level is. If your income levels are lower, then you actually get guaranteed income supplement as an additional government benefit. Now, Canada Pension Plan is a government pension, and that is something you would have paid into over time working. So that one, it will be based on how much you've paid into, but then yes, that's why you should go. We get this for all of our clients, but you go and you request the receipt to find out from the government, how much have you actually paid into CBP. But if you've worked your whole life and you're up to close to retirement, then you would be getting the full amount, and then that gets paid out, yes, for forever. And then with any pensions that are through employers, if you have those, then you would know that if you have spouses, there's survival benefits and there's different options that you can select. So that's part of choosing what makes sense for you and your family based on life expectancy, dependents, spouse, those things. If it's a second marriage, that can add in a whole other layer of planning and figuring out where the money goes. But yes, the government does pay. The government benefits for almost everybody. I will generalize that, but I will say that almost everybody in Canada, that wouldn't be sufficient for retirement. So you definitely need to save beyond what the government will provide. So the 5 tips. Okay. So 5 tips. So the best 5 tips for investment. There's tons of things we could go into, but I wanted to keep this still at a higher level, but to give you some tools that would hopefully either let you ask the right questions to your advisor or have more knowledge when you're maybe implementing the investment strategy yourself. Or if you're interviewing advisors, maybe these will lead to great questions that you can ask them to make sure that they have an investment philosophy that aligns with what you believe. Okay, so always with investing, this repeats a little bit from the cash flow projection discussion, but you have to make sure how much money can you part with for the future. And that's why if we know that we can safely part with a certain amount of money and that it can be tucked aside for the future, we're able to have more flexibility with what we invest in. So that's really, really important. And then how much money can you be automatically contributing into your portfolios? So what this means is if you don't have this already set up, if you're employed right now, figure out what's that extra surplus, make sure that there's something, time it with your paycheck and have that money go automatically into your investment account and have it go into the right account for tax purposes. So that's where we're saying, is it the spouse RRSP? Is it the RSP? Is it the TFSA? And just make sure you're being very mindful of limits. There are penalties if you over contribute, so we don't want to do that. Advisors also should be able to help you with this. For us, we would monitor this fully for our clients and implement it for them. If this is a new concept to you to create automatic contributions, then what you should be doing is maybe consider starting off with a little bit of a smaller amount than the target and keep working your way up. What you can do is you can keep building up that surplus of cash in your account and then lump sum contributing into your accounts. But at least it doesn't create that panic of not having enough money each month for expenses or for your emergency cash fund that you like to have. And by having them set up automatically, again, it goes to the right place, but it also automatically gets invested. So that means you're investing over time, you're getting that compound return, which is going to serve you better in the long run. The second thing is you want to figure out what's the best asset allocation for you. So when I'm referring to asset allocation, that means how much are you going to have in equities, how much are you going to have in fixed income and bonds. So you need to figure out that right balance and right mix. There's tons of different kind of rules of thumb. I personally don't like to follow the rules of thumb. I think that you should be following what is making most sense for you in your circumstances. So it doesn't necessarily mean that you are reducing the equity exposure the day you retire, as an example. The more equity you have on average means the more risk you're going to have. So the more volatility you're going to have in your portfolio. But equity doesn't always have to be matched. You know, some of the equities we use, they're actually considered medium to low risk. And I'm also referring to here, and moving forward in the rest of the presentation, when I am referring to equities, I'm also not referring to individual stock picking. So I'm referring to broadly owned, diversified portfolios, and I'll speak more to the specifics around those in a few moments. So figuring out that right mix, right balance for you, it might be different than your spouse if you have a spouse. That is going to be one of the biggest decision making in how your returns are going to look like for the future. So that is a huge thing that you need to figure out. Let's say in March 2020, I'm using that again as an example, just because it's the most recent, we all remember it. If you felt very nervous that the market had gone down, maybe you weren't rebalancing your portfolio by putting more fixed income into the equity side. But what you shouldn't be doing is you shouldn't be changing your asset allocation at that time. I think that you should be communicating that with your advisor, and the advisor should be taking that into account and coaching you and calming you through that. And maybe when the market recovered, then that was the time you'd be changing that asset allocation, reducing equity. But the goal is that we don't want to be, selling anything when it's down. So when that volatility happens, which is natural and has to happen with public equity market investing, you want to make sure that you can withstand that period. So that fixed income, that bond portion, that's creating that more stability in the account, or at least that's how we approach it. Not all advisors are the same on this. So this is how we approach it. And we approach it that way because we want that to be the really safe, stable area in the portfolio. And also when you do retire, that's the piece where we're taking your retirement paycheck from. So we're probably pulling it from maybe many different accounts for tax reasons, or we're taking it from the fixed income side and then rebalancing the portfolio as needed. Yeah, so figuring out that rebalancing strategy, figuring out, which type of account. So I mentioned that there's different taxation in accounts. So that means that we want to be mindful of, which investment actually gets held in which account. Tax-free savings account, as an example, that's fully tax-free forever. So the name is kind of confusing because it almost implies it's a savings account, but really how we like to approach it, for most people, this doesn't always apply. It wouldn't apply, let's say, if you're buying a cottage and you're going to be using the proceeds soon. Maybe you are using it for medium return investments, and you're going to be fully taking out that money. You don't want it to be taxed. But for the majority of people, we actually use it for retirement and tax planning, estate planning purposes. And because that money is fully tax-free forever, when you pull the money out, fully tax-free, we actually would have the best investment housed in that account. So that keeps that tax sheltered. So if you can, use your tax-free savings account that way, and keep a savings account as just a savings account. Because if you have a money market fund in it where you're earning very little percent, but that's your emergency fund, let's say, you don't need to tax shelter it. There's no tax that's happening in that money market fund. So the third tip is diversify. So I mentioned we're not picking individual stocks. That's our approach. It is a safer approach. If we had a few stocks only and one company doesn't survive, well, that portion of your money is now never going to recover. Whereas when we look at markets, and we'll talk about that in just a moment, we've seen that markets have always recovered, and then they've always grown past the highest point before any decline. So some reasons why we want to diversify beyond that is actually when we've looked at different indexes and different time periods, what we see is that if we were to invest only in the Canadian equity market from 1991 to 2019, we would have had a return of about 8.5%. Standard deviation, that's referring to the volatility we're experiencing, about 13%. So returns fine, volatility's fine. But when we look over to the other, where we're looking at a global diversified portfolio, what we see is a higher return and a reduced volatility, basically. So that is definitely a better place for us to be if we can globally diversify. Another kind of argument for the diversification is what we've done. So this shows laser pointer. Okay, hopefully you can see the laser pointer now on the screen. So what we've seen is, let's say, these are different ways of classifying different investments, okay? And we can pick any color here. We're just going to pick the first one. So Canadian large companies. So what happened to Canadian large companies in 2005? Well, it was close to high returns, not the highest, but close. And then, as you can see, each year, that way of classifying that investment compared to other ways of classifying, well, it kind of goes down, then it goes back up. Then it goes almost down fully to the bottom. Then it goes back up the next 2 years, actually, and then back down for 3 years, and then we start to go back up. So you can see that it's all over the map. So how do we know when that is going to be the best? Some people say that there's different indicators for what we should be expecting in investment, but really what happens is there are a few truths and there's a lot of speculation beyond that. So when we can have a diversified portfolio, it's safer, less volatility, higher return, but also we're there to capture the returns when they show up. So we want to own many different ways of classifying investments, but we want to have, tilts in our portfolios towards areas that have historically outperformed. So we'll talk about those right now. So when we're looking at, again, different ways of classifying investments and what has historically performed a little bit better, well, we have, if we take company size, so you can look at smaller companies versus larger companies. Smaller companies historically have done better. We look at relative price. So is it a value company? Is it a growth company? Value companies tend to have done better. And then we look at profitability, and higher profitable stocks tend to do better than low profitable stocks. And those all seem to make sense. So what we see now across Canada, US, developed, excluding US market, and emerging markets, we see that premium from that tilt showing up across different time periods. So what you can see here, I'll just take a few as examples on the screen because there's a lot of information. So let's take the highest number for company size. So that's in the developed market, excluding US. What you saw is large companies performed well between 1970 and 2020, over 9% on an annualized basis, and small companies performed even better. They actually performed almost 5% better. So that's a great premium. So it's great. It would be a good idea then how we interpret this is, own that broad diversified equity portfolio, but have tilts towards areas that have slightly overperformed. Still own the large companies because we want to be there when we're capturing, but have those tilts towards those premiums of higher expected return. And again, this is just looking at the evidence of what's actually happened in the market over long periods of time. The other example, relative price value versus growth. Let's take Canada, a 2% premium. We'll say, again, looking at growth has done well, value has done a little bit better. And you can see profitability as well, that positive premium showing up. So again, let's take a look. When we talked about inflation and combating inflation, how we need returns. Well, this is another visual that really demonstrates that. So when we're thinking about asset allocation, do we want all of this volatility to get to $28 over time, that growth of $1 from 1985? Or do we want it to be $7, but there really wasn't a lot of movement? Or do we want a combination of the two? Most often we see a combination of the two, but it really does fully depend on your tolerance, what other type of investments you have. So do you own other properties? Are you your own business owner? Tons of different factors need to come into play, including how much you have, how much you want to spend, how you've reacted to markets in the past. And you and your spouse might have different risk tolerance and appetites, and that's okay. But through coaching with an advisor and lots of education, you can really actually train and help yourself. Because, if someone comes to us and says that they don't want any risk, well, we might show them then that the biggest risk then is inflation, and that's a bigger risk than a well balanced, diversified portfolio. So we want to be careful of that. And we want to make sure that we stay invested. So there's, that old expression around, money under the mattress. Well, I thought this visual maybe even depicted that a little bit better. Hoarding onto too much cash is often a sign of uncertainty and I find that from speaking to prospective clients is when we experience this. I understand why people keep cash, but I find that the longer somebody has cash, the harder it is to deploy that into the market. So that's why having that strategy and that plan written out for you kind of eliminates that constant daily decision making. So it makes your life so much easier, and actually will have a much better outcome. So let's not hoard cash. Let's make sure we have the right balance of that safety money, whether that maybe it's a home equity line of credit, even access to, and very little, cash or very, very safe investments. So let's figure out what that balance is, because let's have your money working for you. A study that actually shows, why we should have our money working for us is if you had, let's say, a hypothetical growth of $1,000 invested in the US stocks from 1970. So if you had invested that money, you'd have 121,000 today. But if you missed the best performing day, you missed only one day invested, So let's say you panicked, you took that cash, or you never actually invested the 1,000, but let's say you panicked, you took some cash out because you didn't know, you missed that one day. Now you've lost a potential over 12,000 of growth, just one day. So what happens if you miss those best 5 days? Now that potential 121,000 has gone to only 77,000. Missed the best 15 days. Now your money is only 43,000. So we've lost almost $78,000, which is, it's unnecessary. It's something that we can plan and avoid having this happen in the future. And if we miss the best 25 days, well, now the money's only, about 27,000. As you can see, I've used a roller coaster in the background on this slide because it really does kind of show what can happen in the markets. And, people sometimes feel optimistic, they invest, they get a little bit nervous, there's fear, and then there goes back to optimism. So having that financial plan, working with someone, education, can all help combat that. But really, the biggest fear is not maintaining your lifestyle. So let's keep that fear as like the number one fear, and the rest can be mitigated by proper planning. And we have a few more minutes left, which is great. So we're able to get to estate planning and probate planning. So estate planning, we're not going to go into everything today. I just wanted to highlight a few key things. So in this example, we have a couple. They are both making about 120,000 every year. They have, one couple has 400,000 in his RRSP. Suddenly there's an accident, he passes away. He didn't have any listed, he didn't have a spouse listed as the beneficiary. So what happened is that RRSP money now gets fully taxed the year of death, plus any other income you had. So that 400,000 now is added as if it's income. So we all know what 400,000 would do to our income, and it's taxed. So now we have a tax bill. So basically more than half of that money is now going to pay the tax. Plus now we have the probate expense. Now I'd like to note that these numbers are calculated based on Ontario. Similar concepts apply across Canada, but these are based on Ontario. And so the probate fee for that then would be 5,500. So that's improper implementation of an RSP management, just as one example for estate planning. Whereas if we had proper implementation, we had listed the RSP to have the beneficiary of the spouse. It's a spousal rollover. The money goes fully tax-free to the spouse. There's no tax implication, and it doesn't go through the estate, therefore it doesn't go through the probate expense. So the couple has lost a lot of money from not having this proper implementation. So what we would encourage you to do is take a look at your estate planning, see what your goals are. Again, second marriages might make this a little bit more complex. If you have children from the first marriage that you want to plan for, but then there's some tax planning and protecting your second spouse. So it can get very complicated. It needs to be something that you are constantly reviewing and revising as needed. But for RSPs, RIF accounts, spousal RIF accounts, spousal RSPs, locked-in accounts, all of those are considered kind of the same bucket. Have a beneficiary listed. You can also have contingent beneficiaries, and you can have them as, let's say you have adult children, you have a spouse, have your spouse as the first one, if that's your intention, and have your children, again, if that's your intention, as the contingent beneficiaries, each, let's say there's 3 of them, each a third to the contingent beneficiaries. That means that the money now is going to go a little bit faster to them, skips going through probate, so it still saves the probate expense, goes faster to the children upon your death. There is still going to be, when it's not going to the spouse for RSPs, there's still going to be tax as if it's added fully to your income in that year. So what we also encourage you to do is make sure that there's enough money going into the estate to pay all estate and tax bills. You don't want your executor having to now go and talk to people who have already gotten their money and already spent their money and now say, no, you need to come up with this for the estate and tax bill. So that's the one thing to caution about having, try to skip probate and have everything go directly to your heirs instead of going through the estate. So proper planning though can help this. As well, for the TFSA, you can have your successor annuitant is your spouse, and then you can have contingent beneficiaries. What happens with the tax-free savings account? If you have your spouse listed, is the money goes fully tax-free upon your death, and it stays as a tax-free savings account for your spouse, which is really incredible because that tax-free growth just can continue, which is amazing. If it has someone that's not your spouse, then what happens is the money's tax-free for estate purposes, but then it goes to the children or whoever your beneficiaries are directly, and then it doesn't stay in the tax-free savings account though. At that point, they can choose and put the money in their tax-free savings account if they have room, or they can do what they would like with that money. Definitely make sure you're monitoring this, make sure it's staying up to date, and yeah, that's very important. So somebody asked a question. If you have the spouse listed as the beneficiary, there is not tax. Let me go back one slide. So just to clarify, yes. Okay, thank you, Adam, for clarifying, but I will clarify that for the audience as well. So if I go back to the previous slide, there we go. Okay, so improper implementation was you did not have your spouse listed and there's tax. You have your spouse listed, the RSP, there's no tax implication upon death, upon the first death. Okay, so it's when the money is gone from myself to my husband, then that's fine. When my husband passes away, if he doesn't have another spouse, that money is then going to be added as income for him in that year of death. Okay, so that's why it's really important. We'll take a look down here. So the RSP, RIF, spousals have beneficiaries. The reason I have contingent is in case something happens either to both of you at the same time or happens and you don't have time to update this yet. So that's why having contingent on accounts is really important. Really like to also make sure that your wills and your investment accounts align. These beneficiaries and successor annuitant for the TFSA, that's something your advisor will do for you, or if you're self-directing that you would do. So make sure it's normally done when you set up the account, but it's really, really good and important to go back, revisit, and check to make sure that these are correct. Hope that answers all the questions. Okay, so there is a question around what if my spouse has the tax-free savings account and RSP are already maxed out? This is referring to the estate planning discussion. So in that case, it's actually okay. It doesn't affect their limits at all. So it's a good idea to have both you and your spouse's TFSAs maxed out. And when one of you passes away, it will go to the other person. It doesn't affect the limits. So it's really, really powerful tax tool actually, because it doesn't affect the limits. Same with the RSPs. It rolls over. It basically just, the account name basically just gets changed from your name to your spouse's name upon death. So no limits are applied. And there was also a question around what was the average return for your clients at a mid-risk for the last 10 years? That's a great question. Happy to share that. All the funds we use, all the information is public actually. So quick answer is global equity portfolio for the last 10 years, the annualized average was just over 10%. But that means it's going to vary from year to year. That's if you're in 100% equity. So if you have fixed income, you would expect that return to be less. But you would have expected the return to have less volatility. I think it's really important not to strive for a specific return actually, but really figure out, what return, what risk are you comfortable with? What are you trying to do? And then looking at returns. And because if someone says a 20% return, well, what does that entail? How much risk am I taking on? And therefore, should I be taking on that much risk? Or maybe can I take on that much risk with only 10% of my portfolio? Anything that's ultra high risk, we actually typically don't include that in cash flows. So for our clients, it's not common, but let's say they have a small stock portfolio that they like to play with and have fun with. We might not include that in the cash flow projection because it's too risky, and there's a bit more comfort in not including it. Okay. I'm going to skip over this poll. We're just at the end, so I want to mention a few things, and then I'll make sure I get to any other questions. But I will close out the presentation at 1 and answer any other questions after 1 if there are still more questions. So there's a note going in the chat box. Please feel free to book a follow-up conversation with myself. I'd be happy to talk to you, happy to answer any questions you have. Like I said, I help clients across Canada. So Zoom is an easy way of communicating. So please feel free to book a meeting and a follow-up conversation. Follow us on Facebook, Instagram, YouTube, and LinkedIn. And also make sure you're signed up for our emails. So we have a lot of upcoming webinars, presentations. If you're on our email list, you will get invitations to the ones that are for the public and not just for our clients. And I mentioned this, but we talked about competing priorities and how to maximize your money in the last presentation I gave to the Epic audience. And that can be found on the YouTube channel. So please feel free to go there and find that piece, because that talks more around the different types of accounts and priority setting and tax planning. Our next public, we have a public webinar coming up in December. We also have one in January. So this is the 2021 market summary. We do quarterly market summaries. They're for the public. So please feel free to sign up. There's a link in the chat box. You can actually sign up for this webinar now. As well, you can always visit our website and register for all future webinars. We have the webinar list up on one of the tabs on the website. As well, feel free to email me if you have any questions or want to register. So the next webinar is 30 minutes long, January 19th at noon. And thank you so much. I really hope we're able to connect again in the future, and I hope this was very valuable for you.